Everything you think you need to start investing. A lot of money, a finance degree, perfect timing. You don't need any of it. What you actually need is 5 decisions, made in the right order. Most people get the order wrong. And that's the whole reason they never start. Why your money is losing value right now. Leaving your money in a regular savings account isn't safe. It's slowly losing value, and most people don't even realize it's happening. Think about a cup of coffee. A few years ago, it cost you around $2.50. Today, that same coffee is closer to 4. Nothing about the coffee changed. Same beans, same cup. What changed is your money buys less of it. That's inflation. It quietly eats away at cash sitting still, whether it's in your sock drawer or a bank account earning basically nothing. Investing does 2 things at once. It protects your money from that erosion, and it lets your money start making more money. And it grows in 2 ways. First, ownership. When you buy a piece of a company through a stock, and that company grows, your slice grows with it. Second, and this is the one that actually changes lives, compound interest. That's when you start earning returns, not just on your original money, but on the returns you already made. Invest consistently and earn an average 8% a year, and your first $100,000 might take around 7 years to reach. Sounds slow. But the second $100,000, about 4 years, half the time, because now you're earning 8% on a much bigger pile. The third $100,000 comes even faster. By the time you're near your first million, you could be adding 6 figures in a single year. The snowball doesn't roll at a steady pace, it accelerates, which is exactly why starting now, even small, matters more than waiting until you feel ready. 2 things you must do before you invest. Before you buy a single share of anything, 2 boxes need to be checked. Skip these, and you're investing on quicksand. 1. Kill high interest debt first. If you're carrying credit card debt at 18 to 20%, paying that off is your best investment. There is no stock market on earth that guarantees a 20% return. But paying off 20% debt basically is 1. Investing while that debt sits there is like filling a bucket with a hole in the bottom. 2. Build an emergency fund. 3 to 6 months of living expenses sitting somewhere easy to access. This is the money that keeps you from panic selling your investments the moment your car breaks down or you lose a paycheck. Without it, one bad month can force you to cash out your investments at the worst possible time. And one bonus move once those 2 are handled. If your employer matches retirement contributions, take every dollar of that match. It's a guaranteed instant return you will not find anywhere else. Then if your country offers a tax advantage investment account, use it. Your money compounds faster when it isn't getting taxed along the way. What you should actually invest in. Now the part everyone's been waiting for. What do you actually buy? They look at whatever stock did well over the last few years and buy that. But the past doesn't predict the future. Nokia controlled over a third of the phone market in 2010. By 2020, that was under 1% and the stock had collapsed. Go back to the 2000s and the biggest companies in the world were names like Exxon and Cisco. Today it's Nvidia, Tesla and Google. Betting on last decade's winner is a losing game. That's why, as a beginner, picking individual stocks is risky, or your entire outcome depends on one company's decisions. The smarter move is an index fund. An index fund is a single investment that automatically owns a slice of hundreds, sometimes thousands, of companies at once, tracking something like the S&P 500, the 500 largest companies in the US. One purchase, instant diversification. No need to guess which company wins. You just own the market. Quick vocabulary check, because you'll see these terms everywhere. A mutual fund is a bundle of stocks actively managed by a professional, usually with high fees. An ETF trades like a stock, but holds a bundle of investments, often with very low fees. An index fund is simply a fund, so mutual or ETF, built to mirror an index instead of trying to beat it. That's the whole appeal. No one's actively guessing. So the fees stay tiny, and historically, low-cost index funds have outperformed most professionally managed funds over the long run. If you do want to gamble on individual stocks for fun, fine, but keep it to a small slice of your portfolio you could afford to lose. Think fun money, not your foundation. The 3 mistakes that actually cost you money. The biggest risk to your investments was never the market, it's your own behavior. Here are the 3 habits that quietly wreck beginner investors. Mistake 1. Waiting to feel ready. People sit on cash for years because they want to learn more first. But time in the market beats time in the market. Looking at any 20-year stretch of the S&P 500, through the Great Depression, the dot-com crash, the 2008 crisis, long-term investors still came out ahead. You don't need the perfect plan on day one. You need to start small and stay consistent. Mistake 2. Chasing trends. The moment people learn a little about investing, they feel like experts, and suddenly they're buying whatever coin or stock is trending that week. This is basically the Dunning-Kruger effect in action. You don't yet know enough to see how little you know. Trendy investments crash just as fast as they spike. Boring and consistent beats exciting and reactive every time. Mistake 3. Panic selling. When the market drops, the instinct is to pull your money out, but that locks in the loss. Every crash in history, the dot-com bubble, 2008, the COVID crash, eventually recovered, often within months to a couple of years, and went on to hit new highs. The investors who did best weren't the ones who timed it perfectly. They were the ones who stayed calm, kept contributing, and let compounding do the work. Where to actually put your money. Practically speaking, you've got 2 account types. A retirement account, like a 401k or an IRA, grows tax-free or tax-deferred, but you generally can't touch it until retirement without a penalty. A brokerage account is fully flexible. You can withdraw anytime, but you pay tax on your gains. The order of operations: grab your employer match first, that's free money. Then max out a tax advantage account if you have access to one. Then anything left over goes into a regular brokerage account. Open the account, pick a low-cost index fund, and set up an automatic monthly transfer so the investing happens whether you remember to or not. That last part matters more than people think. Once it's automated, your job isn't to be active, it's to be patient. Set it, forget it, and let the compounding curve do what it does. The whole roadmap in order is pay off high interest debt, build your emergency fund, grab any employer match, put your money into a low-cost index fund inside a tax-advantaged account, automate it, and then do the hardest part of all: nothing. Just let it run. Remember, you didn't need a lot of money, a finance degree, or perfect timing. You needed the 5 decisions in the right order, and now you have them. The best time to start was years ago. The second best time is right now, with whatever amount you actually have. If this helped, subscribe for more videos like this, and let me know in the comments where you're starting from.